US GDP growth beats expectations, but in a Goldilocks way. Tonight's US inflation data could take the Fed within touching distance of 2%. The Nikkei falls the most in 8 years, and South Korea's GDP contracts, making an early rate cut more possible. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, ANZ Economist Bansi Madhavani outlines why a September rate cut by the Bank of England is looking more likely than an earlier move in August.
Wage growth is elevated, services CPI still remains sticky, and both of these are far from levels compatible with a sustainable return of inflation to 2%.
But first, in 5 and 5 with ANZ, US GDP grew at an annualised rate of 2.8% in the June quarter. That was higher than market expectations for around 2% and up from 1.4% in the March quarter. Here's Bansi on what it means.
The GDP growth was robust, with strength coming from consumer spending, traders restocking inventories, and businesses increasing investment in equipment and in software. And when you take both first quarter and second quarter GDP together, the US economy grew at 2.1% in the first half of this year. Now that is very encouraging because it is in line with the economy's potential growth rate, which a Congressional Budget Office report estimated to be around 2.2%. The economic data is falling in this sweet spot for the Fed. Growth is cooling off to a level around its potential rate, and inflation is softening towards the 2% target. The data is an affirmation that the Fed will be in a position to cut rates at its September meeting. Market reaction to the data was subdued. The data cemented markets' expectation of a September rate cut, which is now over 100% priced in.
Number 2. Market reaction to the GDP figures was subdued. By 5 a.m. Sydney-Melbourne time, the S&P 500 was up 0.4% and the Dow was up 0.8%, while the US 10-year yield fell 2 basis points and the 2-year yield rose 2 basis points. The biggest mover overnight was the Nikkei, which fell 3.3%. That's its biggest one-day fall in 8 years, with foreign investors catching up with this week's sell-off in US tech stocks and after the yen bounced through 152 to the dollar. That's its highest level since May. That risk-off tone dragged the Aussie and Kiwi dollars down around 0.5% to 65.5 and 58.95 US cents respectively. Bansi says the focus now turns to the Fed's preferred measure of inflation data due tonight, the Personal Consumption Expenditure, or PCE inflation figure.
Market expectations point to core PCE deflator rising 0.2% on a month-on-month basis, and that implies 2.5% on an annual basis. If the data are in line with these estimates, it would be the lowest core PCE inflation since early 2021, and the FOMC will be within touching distance of their 2% inflation target.
Number 3. South Korea's GDP was weaker than expected in the June quarter, falling 0.2% to bring the annual rate down to 2.3% from 3.3% in the first quarter. ANZ economist Crystal Tan says the pullback was broad-based.
It's becoming increasingly clear that the economy could certainly do with less restrictive policy settings. The risk of an earlier move has increased, but for now we're still comfortable with our forecast for an October rate cut by the Bank of Korea because there are still other considerations for the central bank, including currency weakness, including financial stability concerns that's going to keep it cautious against an early move.
Number 4. The Monetary Authority of Singapore releases its July monetary policy statement today. ANZ's head of Asia Research, Koon Goh, isn't expecting any change to its monetary policy stance.
While they'll be happy that core inflation has dipped below 3%, I think they'll still remain vigilant towards potential upside risk to inflation stemming from a still strong labour market. I think prospects for any easing from the MAS will likely be in early 2025. At that stage, that's when I expect core inflation to head towards long-term average of around 2%.
Now, with the Paris Olympics starting this weekend, there's also hope there will be a shot in the arm for the French economy after the turbulence of recent elections. ANZ head of FX research, Marjabeen Zaman, took a look at the details of yesterday's Eurozone PMI to analyse how France's economy is holding up.
When we look underneath the composite numbers, it does show that Germany seems to be struggling more than France. Germany's composite figure fell into below 50 category to 48.7, and the weakness comes from both declines in manufacturing and services. France, however, looked just marginally better thanks to a boost that they will likely receive from the Olympics, and also the fact that they are moving beyond the volatility caused by the French parliamentary elections and the related volatility in the bond market on the back of that.
Marjabeen Zaman there. Now, in our bonus deep dive interview, Bansi Madhavani outlines why an August rate cut by the Bank of England isn't warranted and why conditions point to September instead.
The Bank of England last updated their macro projections in May, and data since then shows that headline CPI inflation is close in line to the staff forecast. The Bank of England was forecasting headline CPI to be in the 1.9 to 2% range, and that is bang on when you look at the actual outturn. The service inflation front is where it gets tricky. The Bank of England expected service CPI to be at 5.1% by June, but the actual inflation is 60 basis points higher at 5.7%. That is a big miss. What has essentially happened since their May meeting is that energy-related and goods-related inflation has fallen off rapidly, but service inflation has remained elevated. That is something the monetary policy members will be cognizant about.
So why does that point to the Bank of England not necessarily cutting in August?
Look, wage growth is elevated, services CPI still remains sticky, and both of these are far from levels compatible with a sustainable return of inflation to 2%. The fact is that inflation continues to overshoot Bank of England's own baseline view. On that basis, the Bank of England's inflation battle is not over just yet. At its August meeting, they will revise their macro projections. It is almost certain that their near-term inflation projections will be revised upwards, while the medium-term forecasts, which would be forecast from 2026 onwards, those are unlikely to be meaningfully altered. The policy dilemma facing the Monetary Policy Committee is whether to focus on the near-term sticky service CPI or worry about undershooting the inflation target in the medium term. We think the Bank of England needs more certainty from incoming data before cutting rates to address the medium-term inflation risk. What that means for August policy meeting is that they will affirm an easing bias. They will state that it is appropriate to cut rates in coming months, but they want to see further improvement in data before they begin to do so.
Does the momentum look like it's softening?
Look, growth has struggled to recover from the pandemic and from the energy crisis following the Russia-Ukraine war. Private consumption growth especially is particularly sluggish. The economy is operating with a negative output gap, which means that the actual output is way below its potential, and that in itself is disinflationary. High-frequency indicators such as PMI, monthly retail sales, monthly GDP, they show some recovery, but the context to view that growth is that the improvement is coming on the back of this negative output gap. So that is not contradictory with the view that rate cuts are warranted in coming months. Even if you look at the labor market front, outside of wages, other indicators suggest labor market is softening. Since June 2023, 241,000 payroll jobs had been created, of which 161,000 were just in health and social work sectors. The balance 80,000 jobs were in the remaining sectors. The job vacancies to unemployment ratio is off its peak and running very close to its long-run average. All these data affirm that there is further disinflation in the pipeline. The Bank of England will want to see data confirming this disinflation and will have to balance that with not wanting to hold rates for higher than longer than required.
So what other data will the Bank of England have by September to give it greater confidence that it can cut rates then?
The Monetary Policy Committee will have more information by its September meeting. Mainly, they will have 2 additional labour market reports and 2 additional inflation reports. Now, wage negotiations and settlements typically can be a very backward-looking process wherein employees negotiate for higher pay outcomes because of the high inflation that they've experienced in the past. To that extent, the softness that we're talking about in the labour market right now is not reflecting in the wages outcome. So there is a bit of catch-up there to do. But this data can turn rapidly. Our analysis is that the wage growth of around 4% is consistent with inflation framework of 2%. So in coming months, if soft labour market feeds into wage trend and service CPI moderates rapidly, the Bank of England will get confidence that it can begin cutting rates.
Bansi Madhavani there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, July the 26th. Catch you next week with reaction to US PCE inflation data out tonight. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.